Let's talk about the ECB. We've had some inflation numbers out yesterday. We've got the Eurozone-wide inflation number out later this morning. I think it's pretty clear that it's going to pave the way to another ECB rate cut in September. Lagarde talks a lot about wage inflation, and negotiated wages are a big thing in the Eurozone, account for about 80% of the workforce have wage growth negotiated for them. Big drop in Eurozone-wide negotiated wages in the second quarter, falls in other indicators like the Indeed.com listings, the stuff that you can pull from the internet, the ECB's telephone survey of businesses, which they still conduct in this day and age of technology, also points to falling wage intentions. So I think we are on track for further rate cuts again in September, but there is some stickiness. The latest P&I numbers, the service sector surveys, showed some stickiness in the price components of that. So I think some of the people in the ECB will be a little bit cautious. The ECB only has a single mandate of targeting inflation. Growth tailing off isn't really a direct concern for them, it's an indirect concern. But we think the pathway is clear.
No, it's completely independent, not arguable, apparently. But there are politicians all over Europe who desperately need it, from Scandinavia down to Germany and elsewhere. So that's another issue as well. Let's get back to markets as well. I was provocatively saying to the audience, I don't necessarily believe a lot of the actual meaningful rotations going on. I believe the intentions there perhaps to say this is what's happening. Not entirely sure I've seen the evidence of it. By all means, jump in on that conversation.
I think some of that is founded. If you look at some of the positioning data, tech is still a relatively crowded trade. Utilities, which is something I'm starting to favour more and more, is a pretty uncrowded trade. Actually, despite the fact, and you pointed out earlier, utilities doing quite well all year as well as yesterday. So I think there is a lot of rhetoric around the rotation, and there is some moves around it, but there could be an awful lot more to come. Now, why aren't people leaving the tech trade? I think some of that is because a lot of strategists and our research department included acknowledge that we're going late cycle. Growth is continuing to tail off. We've still got a 25% probability on recession in the next 12 months. Not our base case, but elevated. Growth is slowing. There are risks building around US labour market data, etc. In that environment, you want your highest quality cash compounding earners. You do want to pay attention to things like free cash flow yield in those environments. So not all of the tech sector is what you want to own, but some of the the likes of Alphabet, the likes of Microsoft, where free cash flow yield plus the quality of their earnings is just really excellent. You don't really want to rotate away from that. But at the same time, look, we're still overweight small caps. We moved there earlier in the year. That's starting to come good, and we're looking more and more at things like utilities, which again are a great hedge at the moment. They're one of the few sectors where, when macro bad news is bad news, they do well. You've got an acyclical tailwind of the AI story affects utilities because you need all that new power and all that infrastructure. And as I said, they're one of the least crowded trades. Their weight in the American market is near a 100-year low. Wow. They're unloved.